There is one question that I get time and time again, and this is, how should I structure my business entity? Which entity will save me the most in taxes? And if you're self-employed or if you've done any independent contracting or consulting, you've probably heard someone say to get an S Corp because it'll save you a ton in taxes. And you've probably also heard the conflicting advice of, no, not an S Corp, set up an LLC. There's so much conflicting information out there, it's hard to know what the best choice actually is. Which one actually is going to save you money? And when does it make sense to set up which entity? So today I'm breaking this down for you guys. Sole proprietor versus LLC versus S Corp. How each one is taxed, where the real savings actually come from, and the specific situations when switching from one to another actually makes sense. To be clear, this is not legal or tax advice. As you all know, each person and each business's individual tax situation can vary, and receiving specific advice on your own situation is very important. That being said, what I am going to give you is a clear framework on evaluating your choices to help you determine which entity is the best for you, and helping you to become self-informed so that you can have more productive conversations with your tax advisor or CPA. At the end of the day, they should have your best interest in mind, but it is always good to do your own research and be well informed before jumping into a conversation. So let's get started. If you're new here, I'm Julie, your favorite finance coach. I used to be a consultant and then an investment banker before I decided to pursue my passion, which is helping each and every one of you demystify the world of finance and make better decisions with your money. So let's start with one of the biggest misconceptions. An LLC is not a tax classification. An LLC is a legal structure for a business entity. It's not a tax strategy. How your LLC is taxed depends on the structure that you select. Most single member LLCs are taxed the same as sole proprietorships by default. So when someone says get an LLC to save taxes, that's not technically correct. Taxes depend on how income flows and how employment taxes apply. It does not depend on whether or not you have LLC in your business name. So let's talk about what it means to be a sole proprietor. If you earn self-employment income and you haven't elected another structure, you're going to be a sole proprietor by default. There's no formal entity required. All net profit from your sole proprietorship is subject to income tax, and net earnings are generally subject to self-employment tax. Self-employment tax includes things like Social Security up to the cap and Medicare tax. You do get a deduction for half of self-employment tax, but the cash cost is still very tangible. Now, this structure works really well for things like side hustles, early stage businesses, and when you don't have a consistent income from your business. However, once your income grows, the self-employment tax can get very expensive very quickly. An LLC gives you legal separation and liability protection. It also creates a cleaner structure when it comes to banking and growth. As you all know, people who have officially established LLCs are just perceived as more professional. But by default, it does not change how you're taxed at the federal level. A single member LLC that does not elect anything different is usually going to be taxed in the same exact way as a sole proprietor. Same income tax, same self-employment tax. So when you're thinking of an LLC, you can just think of it as an infrastructure. It does offer you some protections and it does set you up for growth. It also allows you to more easily switch to different structures later on, but on its own is not going to lower your taxes. This brings me to S corporations, or commonly referred to as S Corps. This is where real tax strategy begins. An S Corp is not a business structure. It's a tax selection. You can elect S Corp status as an LLC or as a corporation. Now, here's how S Corps actually save you money in taxes. As an owner in an S Corp business, you must pay yourself a reasonable salary. Anything above that reasonable salary can be elected as distributions, and you're going to pay tax on everything, but you only pay payroll taxes on the salary portion of those earnings. The distributions that you take from the business are not subject subject to self-employment or payroll tax. And that key difference is where the tax savings comes from. I know this is a bit confusing, so let's look at an example. Let's say your business makes $120,000 in net profits. As a sole proprietor, nearly all of that is subject to self-employment tax. But as an S Corp, you may pay yourself a salary of, let's say, $70,000. And as mentioned before, this salary needs to be reasonable according to industry standards and market norms as part of the rules of structuring your business as an S Corp. So you pay yourself a $70,000 salary, and the remaining $50,000, let's say you take as distributions. Payroll taxes will only apply to the $70,000. They do not apply to the $50,000, even if you take those as distributions. So depending on the numbers, this can save you thousands of dollars per year. But S Corps do come with some trade-offs. You now have payroll, which means payroll filings are required. You also have reasonable salary requirements, as mentioned previously, both of which tend to lead to higher accounting costs. So when it comes to deciding whether or not electing an S corporation makes sense for you, it is important to weigh whether the savings exceed the complexity and risks of establishing this type of entity. So when does electing an S corporation actually make sense? There's no hard and fast universal income threshold rule, but here's how tax professionals usually think about it. If you're making under $40,000 or so of net profit, a more simple structure, a sole proprietorship or a single member LLC, usually makes more sense. If your net profit is somewhere between $40,000 to $60,000. This is sort of a gray area. This is when it's really important to talk to a tax professional and have your individual situation evaluated. And if you're bringing in a net profit of more than $80,000 a year, that's when it usually makes sense to make the switch from a sole proprietorship or single member LLC into an S corporation. This is, however, if this profit is consistent and you expect it to continue in future years. However, the income threshold alone is not enough to say an S Corp is 100% certainly the best structure for you. You also need to think about whether this is your primary source of income, whether you can justify paying yourself a reasonable salary according to the laws, whether or not you're already maxing out Social Security tax from a W-2 job or not, and arguably most importantly, what city and state do you reside in and where is your business established? All of these factors should be taken into account to evaluate which structure makes the most sense for you. Speaking of location, there is one more factor that can materially change which structure is best for you, especially if you're a high earner in a high tax state. It's called the pass-through entity tax. So what exactly does pass-through entity tax do for you? Individuals can only deduct a certain amount of state and local taxes paid on their federal income tax returns. Before 2025, the limit was $10,000. It was increased to $40,000 thanks to the One Big Beautiful Bill, but it is expected to revert back to the $10,000 cap in 2030. Anything above the current year's cap is not deductible. So pass-through entity tax is a workaround that many states created. Instead of you personally paying income tax, the business pays the tax at the entity level. Because the tax is paid by your business, it is not subject to the SALT cap. What this ultimately does is reduce your federal taxable income. And here's why that matters when it comes to selecting your entity type. The pass-through entity tax generally only applies to pass-through entities like LLCs and S Corps. Sole proprietors usually do not qualify. That means if you remain a sole proprietor, you limit your access to the pass-through entity tax benefits. So forming an LLC or S corporation can help you unlock those savings. Whether the pass-through entity tax is actually going to help save you money depends on the income level of your business. If your state and local income taxes are below the threshold, this benefit won't really help you. But if they're $40,000 or more, the pass-through entity tax could be a benefit for you. This is why people with the same income can need vastly different tax structures depending on a multitude of factors, including where they live. Choosing what entity type works best for you is federal, state, and sometimes city specific. So here are some of the common mistakes to avoid when setting up your business structure. Make sure you don't select an S Corp too early. If your income isn't above a certain threshold, it may not make sense for you. Make sure if you select S Corp, you're paying yourself a reasonable salary according to the rules. It's also important to remember that an LLC does not automatically equal tax structure, and it won't automatically lower your taxes. When making your decision, make sure you pay attention to your city and state taxes and how they're going to impact your income at the end of the year. And of course, as your business grows, you are going to need to revisit the structure and the entity type that makes the most sense in that season of your business's growth. Your business structure and your tax structure should evolve as your business does. So here are some key takeaways for you guys. Sole proprietorships can be very simple, but they can be very expensive as your income grows. So make sure to pay attention to this as your business starts earning more. LLCs can definitely provide protection, but they're not gonna give you tax savings all by themselves. S Corps can help save you real money, but only when the numbers and your location support the decision. The goal is not to avoid taxes at all costs. It's to build a structure that supports sustainability, growth, and your long-term freedom. If you're a high earner and you want help thinking through which structure makes the most sense for you and your business, this is exactly the kind of work that I do in my one-on-one coaching. I help my clients optimize their finances, reduce unnecessary taxes, and build systems that actually support the life that they want. You can find the link to set up a one-on-one consultation with me at the link in my channel description. And just a quick disclaimer, this video is for general education purposes only. Tax and legal decisions are highly individual. So before jumping into any decisions, you should definitely talk to a CPA or professional tax advisor about what's right for you and your specific situation. If you guys found this video helpful and you'd like to see more just like it, please subscribe to my channel and give this video a like. And if you know someone who could benefit from watching it, please share it with them. Thank you guys so much for watching, and I'll see you in my next video.